Hello, my name is Tom Vasello with MRW Financial Brokerage. I appreciate everyone's time today on this quick webinar on using qualified money to fund long-term care. Real quick about MRW Financial and a little bit about myself. I've been specializing in long-term care for over 30 years now. Started off selling what we just called nursing home insurance because that's the only place it paid, and have now moved to where over 90% of our business is in the asset-based long-term care arena as opposed to the traditional long-term care arena. MRW Financial Brokerage is a brokerage general agency based in Tampa, Florida, specialized in life insurance, annuities, and long-term care. One of the things I realized with long-term care is there's a little bit of a learning curve. So we've put together some brochures that you can use not only as presentations but also as fact finders. For advisors that are working with us, we're happy to brand these brochures to your agency identity with your contact information. The first I'm going to show you here, the wild card for financial and estate plans and taking control of your future. They're both initial long-term care planning brochures. I understand most people haven't specialized in long-term care for 30 years, don't know necessarily feel comfortable putting together a plan, putting together a product solution, making recommendations to your clients. So this is going to take you through asking your clients certain questions that is going to help set the stage for long-term care, and then also help me allow you to send that information to your back office, MRW Financial, and we'll put together a comprehensive plan for them. Then you and I can have a conversation about the planning solution, why it makes sense for this client, and how you present it to the client. The third brochure here has to do specifically with the Pension Protection Act. I don't know how many of you are familiar with this, but if you have clients that have a non-qualified annuity, and they don't really have a specific planning purpose for it. In other words, it's probably become more of a legacy tool, quite frankly, because they don't want the income taxes that the withdrawals are going to generate. If we can take that non-qualified annuity with gain, do a partial 1035 or a full 1035 exchange over to a non-qualified annuity, so it's a tax-free exchange that's compliant with the Pension Protection Act, and if they do require long-term care, they can access those funds 100% income tax-free. We can also provide leverage for long-term care. So it's a great way to repurpose an asset on a tax-efficient basis and meet a need for long-term care. But what we're going to talk about today is qualified funds. Now, why do you want to bring up long-term care to your clients? We have found here, and we're always testing different retail marketing messages, there is a tremendous unmet educational need by consumers regarding long-term care. 52% of Americans over the age of 40 say they have a great deal of concern regarding long-term care. 48% of Americans over age 40 acknowledge that just about everyone will require long-term care at some point in their life. This is an important one. 57% of Americans over age 40 have had some experience with long-term care. A parent, a sibling, a family member. They've seen that the government programs and their health insurance isn't there to fund it. And what's striking to me, even though all of these statistics show that over half of the people in America over age 40 are concerned about long-term care, 75% of people age 50 and over have never talked to a financial professional regarding long-term care. Why is that? Clear, and specializing in long-term care for 30 years, I can tell you, long-term care had typically been sold by a Medicare or a health insurance agent as a health insurance solution. Well, really, it's a retirement planning tool. It's a legacy tool. It's an estate protection tool. It should be offered by the financial advisors. But in the past, we have not had good products. We've had products that were use it or lose it for long-term care, have a terrible history of rate increases, and quite frankly, you probably didn't want to risk your core revenue-generating relationship with your client over a health insurance long-term care sale. With the advent of these asset-based products, that's no longer the case. There's significant tax advantages and there's leverage that we can create. Now, if you can gain more accounts with your clients, you're going to make them stickier. You're going to have a higher If you just have one policy or one account with a client, on any given year, you have an 86% retention rate, which is a 14% loss rate. If you can get to that if you can get that to two accounts, that retention rate jumps to 89%. And if you can get to five or more accounts, so if you're a financial advisor and you have a non-qualified account, maybe an IRA for him, an IRA for her, and then cover them both for long-term care, you are so ingrained in their financial plan that you end up at a 94% retention rate. We all know it's a lot easier to keep clients than generate new clients. Now, what is long-term care? Well, long-term care is not the medical support that Medicare or a Medicare supplement is going to pay for. You know, if you go in for a knee replacement and have to have physical therapy in a nursing home after that knee replacement, that's the kind of stuff Medicare is there for. What Medicare won't pay for is when you need assistance with bathing and dressing, when you need supervision due to a cognitive impairment. A long-term care policy will pay for all of these services once you trigger benefits, even including light housework, managing your money, taking medications, using the telephone, caring for pets, responding to emergency alerts. So there's a lot of costs associated as you start to lose activities of daily living or start to deal with a cognitive impairment that's not really medically related that a long-term care policy pays for. We used to start off selling nursing home insurance. Even years before all of these problems with COVID, long-term care is really a plan to keep you out of a nursing home as long as possible. You know, one of the statistics we're going to see is that a average male has a long-term care claim for 2.2 years. The average female is 3.7 years. Doing this for 30 years, I've seen a lot of families go through the claims process, and I can tell you why. I'll illustrate why right now women have a longer claim than men. Typically, us gentlemen get sick first. Typically older, we have a shorter life expectancy, and our wife is there taking care of us informally, not even knowing she's providing long-term care. Last year, I had some back surgery for a while. My own shoes on. Well, that's one of my activities of daily living. My wife helped me out with that. I had problems. She had to be there when I was taking a shower in case I slipped and fell. I was having trouble getting in and out of a chair. That's transferring. Those are all activities of daily living. My wife was there to provide me my care. Luckily, mine was surgery. I recovered from it rather quickly. But if I didn't have my wife there, I would have had paid professional care. Then there comes a point in time, if I had had a more chronic illness where I was deteriorating, comes a point in time where there's a conversation. Mom just can't help dad as much as he needs anymore. So we need to bring in that home health aide to help take some of the stress off of mom. There's community-based services that it pays for. Mom needs to go out and go shopping so she can take dad to an adult daycare. Mom wants to go visit the kids up north, and that's where respite care or community care, a place to take dad while she goes up north for 2 weeks. And eventually there's that conversation where it's just overwhelming for mom. Dad really needs to go into an assisted living facility. I even see people, I'm aware of, a friend of mine just sold his $5 million home up in Fort Wayne, Indiana, and moved into an independent living facility. So there would be some extra care for one of them that needed it. And, you know, as things got worse, you could move to the assisted living, the nursing home, or the memory care unit. And then eventually more end-of-life care is when you need that daily skilled care. Now, us gentlemen pass away. We're usually predeceasing our wives. If you don't believe me, go to the Villages one sometime and see the difference in population between single men and single women. So now mom lives alone, the surviving spouse. And that informal care that was provided to me by my wife, well, there's no one there to provide mom that care. That home health aide that came in 3 or 4 hours a day to help out, well, we need someone there 24 hours a day. That community care that mom relied on isn't there. So what happens is mom ends up in an assisted living or an independent living facility much earlier because she's living alone. And then, of course, skilled nursing, which is more end-of-life care. But that right there, because of the burden that a spouse takes on in the early stages of care in a married couple, and because men typically predecease their wives, that's why women have a longer long-term care claim than us men. Medicaid, which many people confuse with Medicare. Medicaid is a state administered and it's jointly funded by the state and federal government within federal guidelines. It's welfare. It's an income test. In 2016, you couldn't have much more than 20. You couldn't have more than $2,199 in income. Um, the income for the person needing care going into a nursing, and by the way, Medicaid's not an answer for home health care, adult daycare, assisted living. Medicaid doesn't pay for that. It pays for skilled nursing only, and people want to stay out of a nursing home as long as possible. The person that's receiving care, their income is going to go to the nursing home. If the spouse's care is less than $2,000 to $3,000 a month, they might be able to keep some of their care. All assets are looked at jointly. So if you're an individual, you're allowed to keep $2,000 in countable assets. That's it. For a married couple, it's $119,000 combined with the $2,000 ends up being about $121,000. Anything over that must be spent down on your care. Now, there's some exempt assets, such as your home, that's not countable. But outside of that, assets even that are typically asset protected here in Florida, such as pension plans, annuities, cash value, and life insurance, all of that must be spent down prior to Medicaid paying the bill. So if Medicaid's a solution for someone, they're not a prospect for long-term care. But anyone that has any amount of assets, they want to control where they want to receive care. They don't want their entire life savings spent down, leaving a spouse impoverished. Now, regardless of your net worth, and most people over age 65 are going to have Medicare. Medicare has some gatekeepers, and before Medicare will pay for a nursing home, you must be in the hospital 3 days. So you have to have 3 days prior hospitalization. Then Medicare will cover all of your expenses if it's skilled care that's rehabilitative in nature. They'll cover all of your expenses for 20 days. Days 21 through 100, the next 80 days in 2016, there's $161 a day copay. A little bit higher today. I think it's about $172 today. This is the point. After day 100, it's not a Medicare-approved expense. Medicare will never pay. Medicare won't pay for individuals to come in and help you with your activities of daily living. Now, they'll pay for someone after a knee replacement to come in and provide physical therapy and leave. They're great at paying for those medical treatments. It's not great at paying for people to take care of you. So when we look at the breakdown in this country of who pays for long-term care, 43% is paid for by Medicaid in skilled nursing facilities. Now, many of those Medicaid patients started out as private pay or out of pocket, and they sufficiently spent down their assets to Medicaid levels. Clients that are at that Medicaid level aren't a prospect. That's fine. We aren't dealing with them anyways. Medicare isn't really a solution because it's skilled care only, maybe up to 100 days. It's not paying for care in your home. It'll pay for a medical treatment in your home, but not care in your home. The 8%, which is other, are costs that are absorbed by charities and religious organizations. For example, Meals on Wheels, providing those meals to seniors that can't get out. That's a form of long-term care. So really what's left for the bulk of funding, if you have any assets at all, is either out-of-pocket or private insurance. When we see private insurance only covers about 10% of the costs. Long-term care is one of the most undersold forms of insurance. And again, it's because we didn't have great products in the past. The products we have today, the asset-based products, are much better. Now, what's the actual risk? This is for a couple over age 65. If you're a male over age 65, there's a 70% chance you're going to need long-term care. On average, it's 2.2 years. Now, a lot of those are very short-term claims, but if you start getting into the dementia, the Alzheimer's disease, the senility, any type of a cognitive impairment, that's where the claims get a lot longer. I've got an advisor in Jacksonville, Florida, whose mother-in-law had early onset Alzheimer's. She's been receiving paid care for 21 years. For a wife, that female, there's a 70% chance also a female over age 65 is going to need long-term care, but on average 3.7 years. There's actually, when you look at a married couple, a 49% chance that they're both going to need care. So nearly a 50% chance that both of them will need care. If you just go with the averages, that's an average of 3.7 for her, 2.2 for him, so an average of 5.9 years. What's the chance they're going to dodge the bullet? Well, there's only a 9% chance that neither the husband or wife will need long-term care, which means overall for a married couple, there's a 91% chance that one or both of them are going to need long-term care. How can we put together a retirement plan for a client, not put into that retirement plan on average a 5.9 year drag on their income or their cash flow for long-term care. Because long-term care is really more of a cash flow problem than an asset problem. How can we put together that retirement plan when there's a 91% chance that one or both of them are going to need care and not account for that expense? Now, what's been the resistance to long-term care planning? Well, quite frankly, as I've mentioned a couple of times, those original traditional long-term care policies I sold, in hindsight, they just aren't very good. We've had a terrible history of rate increases. The hybrid policies, there's guaranteed you'll never have a rate increase. We're trying to ensure day one, dollar one, rather than allowing a couple to maybe self-fund some of it with a plan for more catastrophic care, which is what the hybrid plans really are. This is a traditional long-term care policy today. For a couple assuming preferred health, they're both age 72 years old. Remember, traditional long-term care, it's use it or lose it for long-term care. You'll lose every dollar of premium if you don't use it for long-term care. Again, that significant history of rate increases. All I'm assuming is a $5,000 a month benefit. By the way, I'm not a big believer in trying to insure 100% of the risk. If the average cost of care today is $5,000, now you got to account for inflation. But I'm not going to try and insure, $5,000 of today's dollars, add inflation on there, and insure 100% of the risk. Now the client can do that if they want. They really want that leverage. But there's a certain amount of my cash flow that I can divert to my own care. If I'm to the point where I need long-term care, either because of cognitive impairment or a deficiency in activities of daily living, I don't need to support my fishing boat anymore. I don't need to support my golfing habit anymore. I don't need to support my automobile anymore. I'm probably not going to be traveling or eating out like I used to. So there's a lot of my cash flow that I can divert to my cost of long-term care. What can we do to cover the difference? Anyways, this use it or lose it policy is going to cost you $21,871 a year for that 72-year-old couple. Obviously, it's two separate policies with a $500,000 pool of money each. Oh, and by the way, those premiums aren't guaranteed. They can be raised with state approval by the insurance company. Let's take a look at an asset-based long-term care annuity solution to generate that same $5,000 a month. So if we have an existing IRA, let's say of $250,000, doesn't matter whose name it is, we can insure both of them on just the husband or just the wife's IRA. We can do a partial rollover of $148,522.20 into, in this case, it's an indexed annuity care. I see some of the names on the line. They're not allowed to sell indexed products, so there's also a fixed version of this. I just happen to show the indexed version. They still have remaining in their IRA $101,477 that you keep and manage however you want to manage it. We're going to take a portion of the required minimum distribution and purchase a continuation of benefits rider, and that's $6,039 a year. The remaining RMD is $3,725. So this is income tax neutral to them. We're not creating any additional income taxes. Many people, my clients, they don't want their RMD anyways. They're upset they have to take it. Okay, let's leverage it into something you can really benefit from. Now, what do they get for that? Well, for that $148,000, immediately they're getting a $5,000 a month benefit per person. Now, again, we're insuring both husband and wife. Now, that annuity will be spent down. That $148,000 will be spent down first, so they're assuming some of the risk. But once that $148,000 is gone, and you can see how the benefit increases, that $6,039 a year continuation of benefit premium that we're paying turns it into a lifetime benefit. So once that IRA is spent down, it keeps paying that monthly long-term care benefit. And if it is it is per person. If they needed care at age 72 right away, if they both needed care, it'd pay $10,000 a month, and that is a lifetime benefit. So we're setting aside $148,000 of their IRA. We're picking up a $6,000 a year premium. Now compare that to what was it before in a traditional long-term care, a $21,000 annual premium. If they don't use it for long-term care, the $148,000 with the growth, whatever it grows over the years, still goes on to their beneficiaries. If they do use it for long-term care, they have an unlimited lifetime long-term care benefit, insulating their other assets from the risk of long-term care. That's just one example for a couple age 72. Let's look at a younger couple, a couple age 60. This one's not going to be income tax neutral, but still we're able to use these qualified funds. For that use it or lose it traditional long-term care policy with a significant history of rate increases, we're going to look at the same benefit pool. We're going to have an annual premium of $8,364 a year. That's paid every year for life. Instead, we can take that $250,000 IRA, split off $139,172 into an asset care annuity, so the remaining $110,000 grows however they want to. It's going to generate $16,701 of annual taxable withdrawals. So they're not actually getting a check, but they're going to get a 1099-R for $16,701 for 10 years, and then it stops. But immediately they're going to have $166,000 of income tax-free death benefit. So we're taking $139,000 that if they were to pass away, that's subject to ordinary income taxes to their beneficiaries, immediately turning that into $166,000 income tax-free. By the way, if they were to pass away in that first year, they'd essentially have the $139,000 less the $16,000 that went over to fund the death benefit and long-term care hybrid policy. They also have a monthly benefit of $5,000 a month per person with a lifetime benefit period. Those premiums are all guaranteed. There's no ongoing premiums that they're going to pick up. They will have to report $16,701 a year in taxes for 10 years, so it's not income tax neutral. So with all of that said, we don't expect you to become experts on it. There's great tools for non-qualified money, tremendous tax planning capability if someone's got a non-qualified annuity that's maybe become a legacy play, or they don't have a specific planning purpose for that non-qualified annuity. Ways we can use qualified money all to solve that long-term care need. We've got brochures like this and fact finds that we can brand in your agency and your identity for advisors that are working with us. We're happy to get that over to you. And really, in about a 10 or 15-minute conversation, I can take you through this brochures. You'll feel confident enough to go out, start a long-term care conversation with your client, collect the information we need to really put together a comprehensive plan for your clients, and then I can coach you through that meeting as well. The other thing we'll do, especially giving all the distance and social distancing requirements. In fact, I have 4 of them tomorrow. If you want me to participate virtually through a Zoom type meeting, we happen to use a GoToMeeting platform, where you and your client can see me. I'm happy to get on the phone with you and your client as your back office product specialist to answer their questions. There's no reduction in compensation for you to do that as well. In my email address, there is a link in there to my calendar. So anyone that's on this webinar, you'll get an email and a phone call follow-up from Meredith, who works in our office. You'll be able to, if you're talking to someone on the fly, go to that email. You can click and book me for a meeting. Then give me a call and let's have a conversation about the client and, and what their situation is. But feel free to go ahead and book me to that meeting. You'll know what my schedule is there. I thank everyone for their time today. If you do have any questions, here's my contact information as well as my cell phone. Thank you and have a great day.